Good day. In this and the following sessions, we shall be looking to see how we can evaluate organizations from the financial point of view, from a financial perspective. Now, organizations can be evaluated from various points of view, maybe from the marketing perspective, from a customer perspective, from a HR perspective, or from an operations perspective. We shall be looking at solely evaluating a company from the financial perspective. Now, to do this, we shall be looking at various key performance indicators relating to profitability, efficiency, and returns. All this put together will help us analyze and understand the performance of a company better. Now, the first measure we are going to look at is net profit. We are going to see the importance of net profit, the hierarchy of earnings leading to net profit, how to calculate net profit, and the limitations of net profit. Now, net profit. What is net profit? A company earns revenue from the sale of its products and services. To do this, it incurs various expenditures. Now, net profit is revenue minus all the expenditure incurred by the company, including tax. This is the net profit of the company. It is an important measure because a company can survive only if it makes a profit. It has to make a profit from its business, otherwise there is no need for its existence. Now, you may have heard the corporate slang, top line and bottom line. Top line typically refers to the revenue of a company, and bottom line refers to net profit. So, in other words, net profit is very often referred to as the bottom line. So, what happens to net profits? Now, the company has equity shareholders who have invested in the equity of the company with the hope of earning some returns. Now, the profits that the company earns from its operations need to be shared with these various shareholders. This is done by way of dividends. The company declares dividends every year, which is just a way of sharing the profits with the shareholders. Now, part of the profits is declared as dividends, depending on the decision taken by the management from time to time, and the remaining profits are reinvested into the business. They are retained earnings. They are used by the business for further expansion plans or such reasons. Now, let's see how we measure net profit. We need to look at the income statement of a company. Now, when we look at the income statement, what we see first is revenue. Now, from this revenue, we reduce the cost of goods sold. Now, cost of goods sold is basically the direct costs, that is, costs which can be clearly and directly attributable to the product. Now, examples of such direct costs are basically the raw materials, the direct labor, power and fuel charges, and so on. So, when we remove these direct costs from the revenue, what we get is gross profit. Now, other than the direct expenses, there are the overheads incurred by a company. These are indirect costs, that is, costs that cannot be attributed to a product directly. Now, these include costs like traveling expenses, communication expenses, advertisement, and so on. Now, indirect costs or the overheads are reduced from the gross profit, and what we are left with is the operating profit. Now, from the operating profit, we reduce interest payable and any one-time expenses. Interest is payable because a company takes debt. It has borrowings for conducting its business, and these borrowings come with a cost which is interest. Now, what are these one-time expenses? Now, these are exceptional items of expenditure or income which the company may incur or earn during a particular year. They are not recurring items. Take a staff restructuring exercise. This exercise would have a cost. Now this cost is not a cost which will recur again in the next few years. It's an exceptional item. So from the operating profit, when we reduce interest payable and such one-time expenses or make the adjustment for an one-time income, what we are left with is the pre-tax profit, that is the profit before tax. Now once we remove the tax from pre-tax profit, what we get is net profit. So finally we have arrived at the net profit, and as I explained earlier, from the net profit we have retained earnings, which is our money invested back into the company, and we have dividends, which is distributed to the shareholders of the company. Now let's look at how the net profit is being calculated in a real life company. We are taking the example of MRF Limited, and this is the extract of the income statement of MRF. Now we have taken the statement for 3 years, that is we are looking at the figures for the year ending September 2010, September 2011 and September 2012. Now these figures are rupees in million. So let's have a look at it. You can see the sales revenue for 3 years. You have excise which needs to be reduced, leaving us with net sales. Now you have the cost of goods sold. As I said, it includes items like raw material, power and fuel, labor costs, change in stock. Change in stock is basically the difference between the opening stock and closing stock of raw materials, finished goods and etc. and any other direct costs. So the sum of all this gives you the total cost of goods sold. Now from the net sales, when we remove the cost of goods sold, we get gross profit. Now we have the operating overheads. These are basically the general and administration expenses, selling expenses, miscellaneous expenses, depreciation and amortization. So the total of these overheads need to be reduced. We also need to make adjustments for certain other income. This is typically maybe interest income earned from some investments. So when we remove indirect expenses or overheads and add the other income, we arrive at operating profit, also known as EBIT, that is earnings before interest and tax. So at this stage we have considered all expenses except interest and tax.